Hi, I'm Scott Shelley, otherwise known as the Cow Guy, here in London for Traders Exclusive. What am I keeping my eye on this week? Well, it's obviously going to be non-farm payroll at the end of the week. Why is it non-farm payroll? Well, the jobs number and the unemployment number, I really don't pay that much attention to those anymore, especially the unemployment number. I mean, geez, with a 4.1, 4.2, 4% unemployment rate, what does that mean when we still can't really get any solid inflation coming through the system? But it is all about inflation, because really it was 4 weeks ago from Friday that we started to see the first wobble in the stock market when we got that wage increase. So the wages increased, the biggest increase I think since 2009 year over year. So that was where the big prize fighter took the first punch in the jaw, and we kind of wobbled there. The stock market wobbled. We've had some wobbles since. We threw a lot of the short volatility folks out with the bathwater. That kind of cleaned up some of the excess risk that's out there. But I still think that we're in the middle of a lot of risk. And we've talked about this word recalibration, recalibrating. What's this world going to look like with a higher interest rates? And then moving towards normalization and what the world should look like if we didn't have the Federal Reserve in our back pocket for the last 8 years. That's a big deal. A lot of folks, and I'm one of them, I would like to see us normalize. But then how can you normalize in probably the most abnormal financial environment we've ever been in the history of the U.S.? So that's going to be a problem. So where are we? Well, I've talked about it last week. We're in the middle. We're in the velocity zone. How quickly is that change going to be in interest rates? I think the most important thing that we saw over the last, say, 10 to 12 trading days was the fact that 1 year government bills, 1 year bills got above 2%, riskless, right? Guaranteed, backed by the U.S. government, 2%. That's going to start to compete with some of those folks that really go for those dividend yielding stocks, right? Because they run the risk of losing a year of dividends if the stock market starts to tank again. And we've seen a lot of volatility. We've seen the president come out with some ideas about some different tariffs. So there's going to continue to be volatility. But what I want everybody to maybe keep an eye on is, the wage numbers coming out again at the end of this week. Whether we see more inflation creeping into the system, we've got about 8 years of it pent up somewhere, right? And then number two, between recalibration and normalization, we've got this velocity stage, right? How quickly do we move from one to the other? And that's really the most important thing. So if we take our time and the market can adjust as we go, I think things will be okay and relatively quiet. But if we start to see that thing winging around and interest rates spike to above 3% very quickly, well then yes, you're going to see the equities not like that very much at all. So it's all about the velocity, that rate of change, the movement from recalibration to normalization. Keep an eye on that. Keep an eye on those real short rates, because they're going to start to compete with the stock market. A lot of things out there are starting to kind of bubble up finally after 8 years. But we'll see what these inflation numbers give us at the end of the week. I'm Scott Shelley, otherwise known as the Cow Guy, here in London for Traders Exclusive. Have a good week.